everyone. Good afternoon. We're thrilled to bring you this panel, and I know we're coming in after lunch, so we'll give everyone a couple minutes to settle in as we introduce our panel here. So, an IPO is an illustrious moment in any company's life cycle. It's one that many founders look forward to and can be a really challenging and exciting process. And so today we're here to talk through that with you and really pull back the curtain, go behind the scenes on the IPO itself. My name is Michelle Casazza. I'm the founder and CEO of Matria. Matria was founded to empower and invest in women through coaching, community, and capital. And before Matria, I was at Casper for 6 years from Series B through the IPO. And my job was actually preparing the company to be public ready and to go through the transaction. And so while I have some intimate knowledge of that specific transaction, I'm really excited today to hear from our panelists who have seen many more transactions than I have and to share their perspectives with you. So before I introduce the panelists, I just want to get a show of hands for everyone here. Who is considering at some point in the future for your company or the company that you're working at as an IPO as a potential exit? The few, yeah. Okay, great. So what we'll talk about today will both help as you think about how to prepare your company and how to set things up now for a successful transaction. And also if an IPO is not your desired exit, what we're going to talk about will also help you mature and build your company's operational effectiveness. So I'm going to get started by introducing our panel. If I were to have an IPO themed dinner party, which I might, so don't put it past me, this would be the dream dinner party guest list. So I'm going to start just by introducing Brittany Ruiz. Brittany is a partner at Latham and Watkins in the capital markets practice, and she is part of a team that's pioneering new ways for companies to reach the public markets. She's worked on some amazing transactions, including Warby Parker, Casper, which is how I know Brittany, Allbirds, and most notably, the Sweet Green direct listing from 2018. Next up is Mike Bufano. Mike is a CFO plus, which I'm excited to talk about what that means.
Yeah.
Mike was the former CFO at Allbirds during their recent 2021 IPO, thank you, and is also experienced with Panera and other consumer brands. Shivani Dasani is the head of the West Coast office for Solebury Capital and a director there. Solebury is a capital markets advisory firm that touches almost every IPO and many other transactions out there, so it's great to have Shivani. I would go through her list of transactions, but it's too long, so I'll leave you just three that stuck with me: Oddity, Oatly, and Olaplex, two of which are brands I use every week. And next is Chelsea Grayson. Chelsea is a former CEO and board member of True Religion, American Apparel, and Spark Networks. And Chelsea has incredible experience working to build consumer brands from the executive level, so we're thrilled to have her here. And last but not least is Michael Benjamin. Michael is a partner at Latham & Watkins and head of the consumer and retail industry group. Michael also has a wealth of experience on transactions. A couple that stick in my mind were Sweet Green, which I eat all the time, and a few more, which I'm sure we'll hear about today. So without further ado, let's get started. My first question is going to be for Shivani. Shivani, there's been a number of transactions that have actually hit the market recently in the last month or so. We've had ARM, Instacart, Klaviyo, Birkenstock, all going public, and some with varying results. And so while they may have cracked the window, the question for you is the window actually open for IPOs?
So I think, this question is it's got different parts to it. I think we have to look at the market as it is today, and it kind of looks like a teenager in some ways, right? Sort of doesn't know who it is yet. Because some days are good, some days are bad. It's trying to figure out what it likes and what it doesn't like. And with an S&P that's up 13% for the year, but a 10-year that's 4.7%, and we only have had 22 IPOs this year, of which 50% are below IPO price. And if you look at how they've performed, the average IPO that's come out this year is only up 800 basis points. That's less than 1% from pricing. So while the IPO market may look open, it isn't necessarily open for everyone, right? It's selectively open for a very differentiated asset that isn't just growing and isn't just profitable, but has a value proposition that is compounding, and also has, candidly, a hook valuation when they go out, as well as a lot of pre-market support, i.e. cornerstone investors that want 50% of the deal, 30% of the deal before it launches. And so the IPO market is open selectively for very few numbered assets, but on the whole, it isn't open, and I think that it's quite unforgiving. And I think you see that in the trading from just how these 22 have performed in the aftermarket.
And Shivani, since I think a number of people in the room will consider an IPO over a course of the next few years, perhaps, can you talk a little bit about what it means for the window to be open and what influences that?
Yeah, so I think when a market opens and an IPO market opens, it opens in stages. The first is from follow-on and block issuance, which is repeat issuance, not IPOs, but from secondary offerings in the IPO market. Those need to perform well. When I say well, they need to hold price and continue to increase. You need to see buy momentum. You need to see volume being traded in these stocks. If the aftermarket performance of blocks and follow-ons hold, naturally the IPO market starts opening. And that's sort of when you want to start thinking about it. Now, there's the first cohort that goes out are the no-brainer IPOs, meaning, the Claviers of the world, the ARMs of the world, that they are a unique asset. They want the print. They don't need to go public, but they'd like to go public. And it's not really a matter of capital. It's a matter of, quite frankly, creating a public currency. And again, no-brainer on value and cornerstone investors. So it opens up in 3 stages. The first being follow-ons and blocks, as I mentioned. The second is no-brainer IPOs. And then the third is everyone else.
Shivani, could you, just for the room, I think the cornerstone investor concept, because the market was so liquid in 20 and 21 and you didn't need that, I think it's helpful to explain what that support is and why it's so important.
Sure. So, we all saw that 2021 was quite a busy year, right? And I think the one dynamic that Mike Benjamin just mentioned is what is called a cornerstone investor. These are investors that effectively have mentioned to you, have committed to you ahead of an IPO that they are willing to buy X amount in your IPO, up to a certain amount. What that means is, to the public market investors, is it's really a vote of confidence, right? You have 4 or 5 names, and there's a specific world of cornerstones. It's not every investor. If they are a cornerstone and you have 3 or 4 of those, they're listed on your S1 cover. And usually they're listed for up to XYZ will buy up to $200 million of your deal. So when you've gone out, effectively what you're saying to the public equity guys is, listen, we're raising $500 million, 250 of that is already spoken for. So there's already that much interest, we don't need to sell ourselves in some ways, right? But of course you have to sell yourselves, but it de-risks the transaction because it's a vote of confidence. We didn't need that in 2021 because there was so much appetite, and we can go into that as to sort of the lessons learned from 21 separately. But the cornerstone is increasingly important. And if you look at the last time the market closed, which was in COVID, 80% of the first cohort of IPOs included cornerstones, because it de-risks the transaction and really gives that validation that the public equity investor is looking for before you go out.
Does everyone know what an S1 is? Okay, good.
Which is
make sure we're
great. Yeah, I was going to check in too.
All the vocab words, yeah.
I think there's a couple of people that have gone through an IPO. Can we just see a show of hands if anyone's been through that transaction before? Okay, great. So when we're talking about cornerstone investors, is it fair to equate that to like a lead investor in an earlier or private round?
Yeah, it often can be, and that's why your private rounds are quite critical, because you want the right partners to really, if a lot of private investors are more willing to come in as cornerstones if they've seen you, right? Now, not all private investors do cornerstone investing, right? So there's a couple crossover funds that will do that. But if you are able to, in your latest stages, start the dialogue with a couple of folks that you think will be cornerstones while giving them the ability to participate in your C or D. That's actually really, it's a really great proof point to the market too. The other thing is, a lot of these late stage investors will ask for participation rights. Those participation rights are on an IPO. And so it's not usually in your best interest to give that away if you are an asset that sells itself. But if you do need the validation, and if you do need that extra vote of confidence, it's always actually really nice at C or D to give that participation rights to a cornerstone, i.e. to a crossover investor that will be a cornerstone if and when you go public. Of course, you need to be smart about the metrics involved there, as in how much, and then how that sort of what that implies to the other investors on your cover. But if you can get those right names in your wheelhouse earlier, i.e. around C and D, and then they come in as a cornerstone, it's a 1-2 punch. It's awesome to show the market.
Yeah, actually, Instacart even did something kind of interesting. They announced an investment from a strategic investor, somebody that they have a partnership with their brand. So they were able to show support from somebody that they had a relationship with, a business relationship with, and that was step one in negotiating a transaction later, a deeper business partnership later. So that was great. They were both able to have this cornerstone investor, but they were able to also announce in their IPO this kind of bigger strategic relationship with another company.
Brittany, didn't what did Birkenstock do something similar with the
Birkenstock
Arnault
did the
family
same.
office, right?
Yeah, and then Oddity did the same. So Fidelity was in some of the earlier rounds, and Fidelity came in on the cover. So the one thing I will double click on is it's not just cornerstones. If you have cornerstones and you go out with crazy bonkers valuation, that's still quite a tough sell. So, you still have to have humility around your valuation and what we call a hook valuation, despite having cornerstone in this market.
So Shivani, that's a great pivot to the next question. So when I was working on the Casper IPO, it was the first transaction like that I was involved in. And it was about 2 months in, and I remember looking around at the team and being like, can anyone explain to me how valuation actually works in the public markets? And I was nervous to ask that question, and honestly, no one could give me a straight answer. And that's when we called the Solebury team and said, hey, can you guys walk us through really how this works? So Shivani, can you give us just a quick overview on valuation, and perhaps other panelists can chime in on how it might be different from the private markets?
Yeah, I'm sure Mike Benjamin can show you a little bit more on the private side.
I know you're serious. You just called me Mike, so.
Can I just call you Mike?
Yeah, you
Benji.
did.
How's
That's
Benji?
all right. That's fine. That works.
So valuation is truly, I wish I could tell you how. There just is no formula for it. It is a compilation of what the investment bankers think of you in terms of your financials, your ECM folk, your equity capital markets bankers who are actually placing your stock, what they think, what the research analysts think, and I always say this, you date bankers, but you marry research analysts. Research analysts, research analysts will...
It's polygamy. Because you want to marry a bunch of them.
You do.
You've got to have a whole bunch of them.
You don't have to pick. You can
and
have all
you
of
have to
them.
keep getting more and more as it goes on. Sorry.
And you have to keep them all happy too,
Yes,
which
you
is
do.
really the hard part. Yeah.
Sounds like a lot of work.
This is Mike's line.
Gosh, this has never come up in a boardroom, but now I'll have to take that with me. But this notion of research analysts is quite critical, and it's something that you can get ahead of very early. You don't have to be going public to start building those relationships. And so it's really a combination of your investment bankers, your research analysts, and hopefully you've spent 2-3 years already speaking to these guys, so you kind of have a view of how they're looking at you with the ECM folks. And then the last bucket, honestly, is what the public market investors are willing to pay for you. You really don't know until the day of pricing. We can sort of triangulate based on your comps, and should you be at a premium or a discount. Ultimately, it depends on what the public equity investors want to pay for you day of, as your order book is building. So it's good housekeeping prior to going public can only help, and we can go into what that means. But ultimately, your value is based on truly how the market views you at the time of pricing.
And the market is very fickle and opaque. I mean, you can be running your company perfectly. You can be generating great, all kinds of great numbers, be very profitable. Your employees can be very happy. And for reasons totally unbeknownst to you, your stock price is either just sort of zhuzhing along juggernaut style or even, sometimes declining, and you just can't figure out how to prop it up. There's stuff you can try to do, but learn how to relinquish control. And it can be really heartbreaking because, of course, and this is a whole indictment on just sort of the way the economy is working now anyway, but sometimes these stock prices, again, have absolutely nothing at all to do with how well you're running your business. And so, but you're constantly watching your stock price, sometimes almost to the sacrifice of how you're operating your company or how you're working your internal numbers. So just get used to that being a metric that you're constantly focusing on, but don't have perfect control over and don't have good insight into either.
Yeah, the best and worst thing that ever happened to public company CFOs is the stock app on your iPhone, because the number of people that would just stop me in the kitchen, whether at Panera or at Allbirds, and ask, why is the stock up today? Why is the stock down today? I'm like, we did nothing different. Like literally nothing has changed. I am no better or worse as CFO based on what you see on your phone. But I do think underneath that, there is a temptation, especially when you're newly public, to respond to every piece of feedback you get, every piece of information, every input. And I think that can distract you sometimes. It's probably similar to your journeys now as founders. As you go through a fundraising, you hear all this stuff and you almost want to shift the business exactly towards whatever investors are telling you or what their questions are. And I think there's value in that because they're a stakeholder. But remember, who is your core customer for your product or your service? How do you do the best job you possibly can for them? Do you have good unit economics, the discussion folks are having this morning, and are being smart about growth? And in the end, like the stock price does catch up with you, good or bad. If you're running a great business, the market will realize it over time. And if you're not running a great business or the economics of the business are sideways, it's ultimately going to catch up with you on that direction. But it's hard. And at Panera, the founder always said, we are not our stock price. Now, it was easy for him to say that 30 years in when he was worth like $500 million because he had won by that point. But it is a pretty true thing that you have to remind your team, even your valuation or your 409As, that doesn't determine how great the company is in that moment. Build a durable business that can last the test of time.
Yeah, one thing. I agree with that, and I think the one thing that I'll say is a really solid FP&A team and a really solid CFO is quite critical to going public. And if you sort of step back from that, they need to work a year before you go public on a beat and raise model, and an actual model that you want to show to the street, and an actual model that you want to show to the bankers, because bankers are, they are unforgiving when it comes down to value. If you sort of start talking to them and your numbers are in one place, and then you go public and your numbers have shifted, it's not a 1-for-1 exchange. They'll hit you like 3, 4, 5 turns, right? It's not just they came down 20, so my valuation's lower than 20%. If they've come down 20%, your valuation's lower by 50%. So, having good housekeeping in your FP&A team and having conviction around your assumptions is critical. But the one data point I was going to bring up is, Etsy's a great example of, they did everything right. They missed their first quarter out the gate. So they went public, they missed one quarter. They then beat and raised every other quarter out the gate. After that point, increased guidance, did an amazing job in the public markets. They did not get above issue for 2 years. They were penalized that much for missing the first quarter out the gate. So only go public when you have a really strong sense of self and you have a really, really tight financial, FP&A team that has conviction in their numbers.
So we talk.
If I could just add
ahead,
quick
Mike.
thing, this is what beat and raise means. What she's talking about is the expectations that you give the outside world and those Wall Street analysts who cover you, what your forecast is for your business. And that may be very different when you become a public company, where when you're private and you're early stage, you're selling the hockey stick, right? The accelerating growth, the fact that you're picking up this momentum. So the mentality for you as a founder and a management team is very different, because what you want to do is tell them you'll do this, do a little better than that, bring them up for the rest of the year. It's like the old line that happiness is like reality minus expectations. That's very true when it comes to the world of investors.
And you have to be so disciplined with it, because you might, you were so right about having the best CFO and the best FP&A team for the job, because you have to know sometimes, well, I'm going to do this much better this quarter. I could do much better, but I want to save some of that stuff for the quarter after that, or for next year, and I want to be able to make an announcement about this and such in 12 months. So I'm going to, do breadcrumbing up until then. So you have to be very disciplined and very methodical about how you beat and raise and when.
So, Mike, you talked a lot about the difference when you're private versus public, and I think that's a big theme here, right? When you're moving from a private to a public company, there's a significant amount of transformation that happens to the business, to the management team, to the operations. And so what I want to just double down on here with the panel is, what are some of those areas that you're focused on, or that companies should be focused on as they're maturing from private to public?
See 5 mics go up.
Yeah, no, we could stay on this topic for a while, but I do want to hear some areas of focus from the panel.
Maybe I'll start it off. I think two sort of opening thoughts. One is, for everyone here who's got a mix of sort of angel, venture, growth type investors, you're going to have a pretty dynamic board. And the first thing you should tell yourself is, if we want to go public, the best laid plans will come unstuck, because the board will tell you to go when you're not ready. And they will do that because the market opens at times that are convenient for investors, but not necessarily convenient for companies. So it's actually essentially impossible to be over-organized. The other thing is, every cycle creates lessons. I am both old enough and young enough to have seen Web 1.0, Web 2.0, 07 and 08, 2015, and then the great COVID IPO boom, and now the hangover. And so the lesson that I would sort of give this room, or share with this room, is an adjunct to what was just discussed on FP&A. It's one thing to have your numbers right and have the demand side, like know what the revenue opportunity is and what the TAM is for your business, and have a plan on how to capture it. It's another thing altogether to have the operating infrastructure to actually execute on that. So you could have the model bang on, but then you underhired or you hired the wrong people and you just weren't able to capture the opportunity. And then you'll end up in an Etsy type situation where you'll miss one quarter and you'll get crushed. And you're going to have this tension because you're going to want to build out the team even more, and there's a natural transition, and Michelle, I don't know if now's the time, we can talk about it later, of when a founder who is so entwined with what the business is needs to create space for other expertise to come in and really help scale and build out that team. But that, to me, was the lesson from 2021. Yeah. So many of the companies that have been crushed in the market since are phenomenal businesses, great ideas, tremendous brand equity, customer engagement, huge TAMs, but they just weren't able to invest in the right number and the right type of people to go out there and create the operating infrastructure to capture the opportunity.
So I always think about this in the lens of people, process, and systems. So when you're maturing the company, when you're going through these transformations, you have to think of all three. And these are things you can think of at any point in your business. We had some panelists earlier talking about forecasting and having to get better at forecasting to meet demand and to grow the business. And of course, that's absolutely necessary at that stage. And it becomes even more critical when you're showing your results to the public markets, because as Shivani said, they're not forgiving, and you're expected to be able to put out projections and then beat those projections every single quarter. And your forecasting, which is tied to your operational platforms and your data quality and your the expertise of your team, is what's driving that accuracy of your forecast. And so as you sit here now, if if an IPO is not immediately around the corner, these are things you can keep in mind to build the operational efficiency of the business. I think it's a really great point. I mean, I think you doubled down on the founder point. There's the operations. What else would you guys say is you should be focused on as you think of IPO preparation?
Yeah, I mean, I think, and we've touched on it a little bit, you touched on it when you were talking about starting to sort of curry favor with whoever your big lead investors are going to be. You know, you might include them in a couple of penultimate rounds before you take it through. I think communication and relationship building are two absolute cornerstones to being successful as you transition from private to public, and it's a completely different form of communication than what you've been doing as a private company, of course, because all of a sudden you're going to have to shift to understanding material non-public information and all the parade of horribles that go along with disclosing that stuff improperly. Yet there's the tension between not disclosing material non-public information inappropriately, but also needing to communicate freely, openly, and transparently with various stakeholders that touch the business. First and foremost, in my mind, are the employees, who are clearly the most significant and valuable asset of any company. You definitely don't want your employees to be finding out things about their company from the press or an 8K that got filed that morning or a press release, or on social media. And that's going to happen more and more if you don't watch it as you become a public company, because all of a sudden there's so many different eyeballs on the company and people who want to talk about the company in different rooms. So, be vigilant in putting your oxygen mask on first, right? Communicating with your own employees first internally as much as you possibly can, even if it's exactly concurrently with when you hit the button on filing an important 8K or something like that. Make sure that you're communicating with your employees. And to your point, excuse me, make sure that you're communicating often with your investors, the investors that you had pre-IPO and the investors that you continue to have or that you want to have post-IPO. Go to all the investor conferences, spend tons and tons of time on airplanes traveling to those investor conferences and pressing flesh and meeting with people face to face and making sure that they understand your vision behind the scenes, that they'll support you, in front of the scenes in the actual capital markets. That is very, very important. Don't get insular. Don't get so focused on running the business that you're not out there, talking to your investors and your potential investors and your analysts and your potential analysts, because you're absolutely right. Coverage is the thing that can help make or break your stock price. And at the end of the day, it's all about your stock price, and that can help you get into that black box. And then finally, I'll just say, as a public company, it's also very important to constantly meet face-to-face with your supply chain, your vendors and your suppliers, whoever your manufacturers are. Because again, you don't want them getting skittish to the extent that they hear or read something in a filing or, on Squawk Alley or whatever in the morning, and you don't want them starting to get skittish and starting to shirk on their obligations with you or not wanting to re-up a very important contract with you. You want to make sure that they're as much in the loop as possible and that they don't get surprised so that you can keep things running smoothly.
To add to what she said on the investor point, bringing your investors in the loop, making them part of the process is super important because you need them to support the IPO. They may be buying into the IPO, and I've actually seen this go wrong very recently where kind of as an afterthought, the company brought up something that they were contemplating and the investors were very upset and they didn't like it. And they were so upset because they hadn't been in the loop that they said, we're not going to support your IPO unless you completely kill this. Right? So you really want to bring your investors in the loop, especially when it comes to decisions of control, right? Because one of the things, if you're a founder or of a company that's potentially thinking about IPO, one of the things you'll spend a lot of time talking about with your lawyers is control. Who has it and how do I keep it? Right? And there's various mechanisms through which you can maintain control, right? What you saw a lot during the COVID IPO boom was dual or multi-class structures whereby some group of people or a person had a high vote class of common stock that allowed them to have 40, 50, 60% voting power in the company. So you saw a lot of that. So you'll be, when you're thinking about those things, you'll want to talk to your investors about that because ultimately they're going to be the ones that have to approve and sign off on that. And it also becomes a marketing point, right? And if investors like you, if the market likes you, if they think that you're going to be a competent, great CEO founder, then they're going to be fine to give you that control. But you'll want to talk about that with your investment banks, with your lawyers, see what the market will tolerate.
With your advisors.
Yeah.
With Solebury.
So with your other advisors. The other thing I would say, and this was brought up before by Shivani, and it's kind of a plug for you guys, but unintentionally, one of the things she brought up was the research analyst point. Now, legally, there is a point in time at which research analysts have to be quiet. And so when they know that there's a bake-off coming, i.e. when they know that there's an IPO around the corner and that their bank could potentially be hired for a mandate, they can't, the dialogue has to shut down between the company and the research analysts. And so you want to start talking to them before, like well in advance, so you can kind of have a two-way dialogue with them and really build a relationship before you're thinking about baking off. So that way you can have more fulsome discussions. And that's where Solebury comes in, where they kind of know all the research analysts. They can kind of tell you who you should be talking to and help guide you through that process.
Yeah, thank you for that. And Brittany's absolutely right? Solebury, how we got started is really, people, KKR, basically said, listen, we feel like we need an intermediary that's not a bank, that's not, a consultant, that's not a lawyer, someone that's unbiased. And because we're not an underwriter, there's one party that can do this and actually bring you to research analysts, and that's Solebury. But to double click on this point around research analysts, Brittany mentioned, the legal ramifications, right? So before banks are involved, your research analyst conversations are two-way in nature, meaning it's free-flowing dialogue. Once bankers are involved, now you have a syndicate of research analysts. It becomes one way, and they can only hear you present. You cannot ask for feedback. It's not a two-way dialogue, and so you want to be able to get that done early. And when I say early, I mean ideally, and that's when Solebury gets involved. 18 months before an IPO. That's kind of the sweet spot. The other, and this is external housekeeping. There's sort of two things in external housekeeping. It's research analysts, and then it's an NDR. An NDR is what we call a non-deal roadshow, where you're not meeting existing investors that have participated in your private rounds. You're meeting public equity investors to get a sense of how they're viewing you. What are they liking about your story? What are they not liking about your story? Do you need to go back to the drawing board and put pause on the IPO? It's a way for you to validate what you've been doing behind the scenes with those that are going to buy you. And this is, again, without an IPO in mind. It's truly a non-deal roadshow. And again, you can do this, the best ones do this early, a year or 2 years before. And that
Don't you think even 2+ before?
Yeah. Ideally,
if you're on, let's just talk practically here. If you're on the conference circuit, right, if you're out at any of the major banks or the mid-tier banks, consumer retail conferences, or digital commerce conferences, and there are analysts there, and you want to retain the option of an IPO, sit down and have a one-on-one with them while you can. Talk to them, talk to investors, because so many of what we call the long-only IPO investors actually have like sleeves for earlier stage and for crossover. They want to meet, everyone wants to meet hot companies that are, essentially populating this room now,
and
earlier
there's a
and
reason
earlier.
for that, right? There's a reason. Well, and why do they want to meet you early? It's because they want an allocation. Like that's the point of relationship building. They don't want to, think about it like a first date. If your first date was 2-3 years before you actually go public, by the time you go public, they know you. You'd be more inclined because they have buy-in into your story. Therefore, they get an allocation.
Solebury have a marital advice arm as well.
So we're back to the dating
Can
analogies.
I emphasize something Shivani said though?
Yeah,
About,
go ahead.
because it's this important point of, yes, it's a 2-year, 18-month long process. You are doing all this hard work. You're spending a lot of money on your advisors. You're developing and further developing your story. You're going out and meeting all of these people. But it's okay if you hit a point where you need to pause. It's okay to pivot. There's no shame to that game. Take your ego off the table. Yes, you've talked to a bunch of people, you told all your friends you're going public, whatever the case may be, but if you hit a point where you get feedback, or whether I'll share an anecdote, it's an extreme anecdote momentarily, but you hit a point where it's just obvious for business reasons, this is just not the right time, it is okay to press pause. S1s go on file all the time and then get taken down. This is absolutely typical. I was brought onto a pre-IPO board to be the lead independent. which is just a fancy schmancy way of saying chair, sort of. I'll just generalize here, but the lead independent.
Adult in the room.
The adult in the room, right? And that's a whole other point we should talk about at some point, is just the idea of assembling your board of directors that's appropriate for your new public company versus the board you had when you were a private company. But putting that aside, I was brought onto a board to be a lead independent as we headed towards our pre-IPO and IPO. And the Russia-Ukraine conflict broke out, and nearly a quarter of this company's business was done in and around Russia. And so we had company-specific reasons why our numbers were no longer going to look as good for a period of time as we shuffled and sort of tried to respond to that conflict. And then the macro environment, the IPO market just absolutely, the window closed, as it were, and it became really obvious that we were going to have to pull and rejigger. And I decided to step off the board because they no longer needed the adult. They could do it without me. But it's perfectly fine, and you can circle back to it, when the time is right, and tell that story, about why you did it, and the market will actually appreciate your constraint and your.
So I do want to pivot. Do you want to make one final point on that, Shivani?
That is the point of the NDR.
Right.
Is so you can calibrate. How far are you? And it's okay to be far and then, press pause and come back 2-3 years later with a fresh face. What I will say is they don't forget. So if you share a number, you better have conviction in that number because they don't forget anything.
I had one just super quick thing to this on this idea of
super quick.
It's okay to back off.
No, go ahead.
What we did was we set up for ourselves when we started the process what we thought our go, no-go criteria were, and they were about the state of the economy, the state of the market, getting the board built out, how the business itself was performing, did we have all the key capabilities in place internally. It was a really thoughtful thing, but we did that up front at the very beginning, because the deeper you get into a project, the worse your decision making gets, because there's the fallacy of sunk cost, right? You're this close, I can talk myself into it, but if you're really clear up front about what your decision criteria is, you can always go back and evaluate yourself against that, and then you have to be intellectually honest in those moments, and it's okay to pause or pivot or do something different, but set yourself up front to make the best decision.
Great point. I mean, we could talk about this for so long. I want to have 2 more questions, and then we'll open it up to the audience for any questions you may have. But everyone here has talked a lot about the advisors, right? So I've never been in such big meetings than when we were doing IPO prep. Like every single meeting broke the Amazon 2 pizza rule. Every single one. They were like as big as this room here. So my question that I'll toss over to you, Mike, is around selecting that advisory group. How do you think about selecting the right partners, from the law firms to the capital markets advisors, so on and so forth, the list goes on, to assemble that team?
Yeah,
be nice to us, Mike.
The first thing is, again, we use Solebury as well. They were incredibly helpful for us because they're a little bit like your Sherpa for a process like this. So I had already been a public company CFO. I had done a huge transaction selling a business, and even then an IPO is a unique transaction in and of itself. So figure out who you need and what the team needs to look like over what time horizon. For me, I kind of indexed on a few things. I think the first was that the reality is there are certain banks, law firms, it is a relatively small group of people who have phenomenal expertise in this stuff. So you're going to start looking into that group of people, figure out where you have the best relationships, try to build those relationships early on. So whether it's you or your CFO, meeting with all these banks, getting to know them, starting to get a sense of the personalities and the decision making. The second thing that I think is do as much background research as you can. Your network, someone said earlier about how powerful LinkedIn is, I think because that's how they found Jennifer Aniston, or Jennifer Aniston found them. I don't know if Jennifer Aniston can give you feedback on bankers, but someone in your network certainly can. So really try to get that on the personalities. And then the last thing, and this was really like Brittany was one of our closest advisors during this process, like if you can, try to pick people who you are comfortable spending an enormous amount of time with, where things are going to flare up a little bit, you're going to be a little bit tense, they're going to be a little bit tense. Brittany and I learned a lot about each other's pop culture preferences during this whole process. I learned a lot about Matt from Solebury's tennis game. I think everyone knew I was moving across the country because I literally was in different places, in different calls, in different Zooms along the way. But try to pick people you're going to really enjoy working with, and not just because the process is hard, but because in a moment when you have to make a really hard decision, the people who you've built a really good rapport with are the ones who are going to give you the best advice, and it's going to be the honest advice they're going to give you, and you have to trust them.
I couldn't agree more.
Point, and it's so powerful.
Can I say one thing that's a little bit
Thanks, Mike.
overtly self-serving? It's really important, among other things, to show cost discipline at earlier stages. there are a few things that are bet the farm when it comes to growing a company. One is if you're getting sued, and it goes fundamentally to your ability to continue to run the business. And another is when you want to buy a company or sell a company. And an IPO is a sale. You're selling to the public markets, even if you're only selling 15 to 25% of the business. It is a sale. When you're in bet the farm mode, it's like building a house from scratch. So even if you've got really good advisors who've been so loyal to you and helped you out with cost and all of that along the way, there are certain jump-off points where you want to reassess your relationships and what you really need from a service provider. And 2-3 years out from a sale or an IPO is when you want to do that, even if there is some pain around the cost of switching, whether it's economic or bureaucratic cost. But it's really important, and I think for those who have vibrant boards with a lot of different investors on them, I think you'll find the board's quite supportive at that point in time, because when you're in bet the farm mode, what you don't want is to have something go wrong because you were reluctant to switch horses. It's very easy to look at these things in hindsight, but there are certain moments where you want to step back and really look at your relationships. I can't tell you the number of times that we were counsel across the table from some really well-known brands that, we didn't win the pitch for, right? Which is never a good day at my house if I lost a pitch. But, and then, you're across the table and the company gets sued for something. And there's a company that I have in mind as I tell this anecdote. And then we get a call saying, hey, we'd really like you to help us out with something. That's not schadenfreude for us. That's, we're in the business of helping companies. It's a passion for us. But that is the time to take that reality check.
So much about the relationships related to the IPO. I think next time we can even rename this panel to be like the relationship advice for IPO navigation. So last question, a little bit of a fun one. Mike mentioned how you're kind of going all in when you're working on a transaction like this. And, I work with founders a lot talking about balance and how to strive for balance over a lifetime. Because when you are building a company, when you're going through a transaction, there's no balance. You got to dive all in. But so I do want to ask the panel, as you're working on these transactions, supporting clients through them, how do you maintain a sense of balance? And Shivani, maybe we'll start with you.
I don't know what that is. Would you like me to start?
I would love you to start, yeah.
So let's be honest. I think, we all strive to seek balance. I think it's okay to not have balance in periods of your life. When you're going public, it will take everything out of you. It is okay to not have balance in that sphere of your life during that time. So with that said, the best piece of advice that I've ever gotten was find something that you're completely obsessed with outside of your day-to-day. That's like your guilty pleasure that is got nothing to do with your job, that just gives you, that you simply do it for pleasure. And, it can be anything from cars to watches to sailing to travel, whatever, but find one of those where you can just escape and be obsessive about it. And I think that, at least for me, keeps me balanced.
I think it's fantastic advice. Do you want to share what yours is?
Mine is shoes.
Not the answer I was expecting, but to each their own.
Mine is shoes, and it's perusing, it's buying, it's just, even if it's window shopping, it's a release for me. I'm sure I need, more life lessons in life to find a better one, but right now it's shoes.
Well, I don't have the magic answer here by a stretch. Anybody who knows me will know that I'm not good at this stuff at all. But you better find whatever it is for you. I totally agree. Whatever that answer is for you, and it's not one size fits all, find it, because going public is an event. It's like that happens, and then that sets the tone for all the years after that. Whether or not you stay public, you go private, you file a Chapter 11 because, God forbid, you have a liquidity crisis, whatever the case is, that is going to be your life from that point on. And so you better find your way through it without, raising your blood pressure and have a cardiac arrest.
I have so many things to say, but I'm going to say one. It's just business. And you need to remember that so many people in this room have given birth to companies and ideas, and an IPO is an incredibly transparent and illuminating process, as in the light is shone on you, and if you're a founder or an investor and you've staked your reputation on the company, it's going to feel very, very personal. It's not. It is, for better or worse, about money. And so it really is about business, and if you can try to remind yourself of that reality at times when it feels very personal, I think it can be helpful.
Yeah, great.
I agree. I think building a business is much harder than going public. So if you can just remind yourself that you've built this, I mean, it's much harder to build a business than go public.
Being public is much harder than building that business.
Correct.
Being public is the hardest thing.
I actually want to
Yeah.
come back to one thing, and Brittany, I know that you want to share. Why don't you go first? Because there's one thing that's been bugging me for the last 50 minutes that I want to get off my chest.
I would just say going public is a lot of work. And what often happens is, and we've kind of alluded to this before, you think going public is 2, 3, 4 years out, so you're not really preparing, and then one day your board is like, it's time to go. Start preparing early because you have a 9 to 5, and then going public adds an additional full-time job, and it takes a huge toll on your employees, and we see this all the time. If you can stretch out that process for them so that they're still able to focus on the business and doing what you need to do to make money and making the business successful, that will make the whole process successful, right? And the IPO successful. So treat your employees well, give them time in advance to prepare by getting started earlier so that they're not jammed and that they can still focus on growing the business.
So,
Sorry, just to add on to that, just real.
Oh, sorry,
quick,
I
and this
forgot
is part
about
of
you,
the
Mike. You were
balance
stuck
thing
there.
Too, is I know you're waiting to get it off. We'll get it
yeah,
right
no,
off before the
it's
buzzer.
killing me.
No, I think on the part with your teams and your employees, it's also celebrating the victories along the way in the process and having the moments. Like when we filed our confidential S1, the team had worked so hard to get to that deadline. We blew off a lot of steam that day, right? And it wasn't the end of the process, but it was a really fun and a really important day. And to me, that was a bit of a balance as a leader because I wanted to make sure my team felt appreciated and they had their time to be able to be healthy and happy. And for me, it comes down to just think about whatever your day-to-day is and how you balance your physical health, your emotional health, and your mental health. And those 3 things can be very different. Like I journaled a lot during the process, 1, so I wouldn't forget it, and 2, because it just got all the anxiety out of my head, honestly, about everything kind of going on a day-to-day basis.
It's a great tool, Mike.
It was helpful. And then I also
awesome.
was training for a marathon at the same time, which I would not recommend doing a marathon 3 days after an IPO. That's a no. That was
That's
a
a
lesson
hard no.
learned.
That's a marathon
I was
option.
horizontal for
It
5
was
days.
it wasn't planned that way exactly. It was not my best race. You'll be surprised to hear that.
Amazing.
Not my
All right, well,
fastest.
let's give Benji the mic for a final point,
So
and then we'll take a question
I
or 2.
would say, look, we're in a room full of people here who are focused on brand equity and marketing, and I think if this panel was to be given a grade for marketing, the bona fides of an IPO would get an F. We probably made it sound like a miserable, horrible experience where all you do is get judged by everyone you meet for the entirety of the process. I want to make one point here as someone who's seen 3 or 4 huge cycles in the IPO market since the late 90s. An IPO is a phenomenal achievement. It releases enormous value for people who create businesses, for people who work for people who create businesses, for advisory ecosystems that generate phenomenal ideas to release value. They're an incredible amount of work, but like a lot of things that are an incredible amount of work, they're worth it. And there's a reason that there's still a magic around like pushing that button at NASDAQ or ringing that bell at the New York Stock Exchange, because it is a marquee event. And that there may be many, many people in this room for whom it doesn't hold much allure, and that's perfectly fine. Selling a business at a huge multiple, and greenfielding it from just an idea is no less of an achievement. But as you think about all of the stakeholders in a company, I think I would ask all of you consider don't be turned off by the intensity around an IPO and that constant accountability. I still think it's an unbelievable way to go for the right business.
Thank you. I think that's an amazing point to wrap up the panel. See, if we have any questions in the audience, just to wrap up. Are there any questions there in the back? Go ahead.
Really interesting panel. Thank you.
Thank you.
A lot of clients who are in the earlier stages of their trajectory,
It's a great question. Safes were does everyone know what a safe is? Because a lot of people do, some people don't.
It's like 50-50.
A safe is a well socialized instrument for early stage companies. The whole early stage fundraising ecosystem from a legal perspective is streamlined to minimize legal spend, which it should be. You shouldn't be draining money that you raise on on people like Brittany and I. There'll be a time and a place for that, but it's not early stage. We as a firm don't love safes, but the reality is we're in an environment where the capital has all the power, but I've not really seen drive from investors that they want to be in a safe. What investors, I think, are now focused on is an appropriate balance of control. I think the shift has moved significantly, the focus has shifted significantly from valuation to investors having a say in the business. The number of growth companies that couldn't get public in 2021, where I've spoken with growth fund clients of ours who've said, I can't believe I signed up to these documents where I don't have information rights, I can't speak to management and force change. I think that is the emphasis for investors, is finding that balance between founder control and controls that investors can have. So we're not talking about safes as much as we were a couple of years ago. Hopefully that answers the question.
Okay. All right, great. Well, thank you so much.
Yep.
We could have talked for a long time, but we hope you guys left with some tactical advice, and we appreciate everything.
Thanks, Michelle. Good job.
Thank you.
Thank you.